Hey everyone, welcome back to Corporate Decoder. Today, Mangaceuticals Incorporated just filed an 8K report, and it looks like a big deal they're backing out of a merger. Quick note, this is not financial advice, just my take on public filings for educational purposes. They were planning to combine with another company, but that is now off the table because they couldn't secure enough funding. So, Mangaceuticals Incorporated, ticker symbol MGRX, had a plan to combine with Nuclear Energy Incorporated. Think of it like a merger, where two companies become one to achieve some business goal, often to go public or to expand. This deal was supposed to happen through something called a business combination agreement, but on the 19th of August 2026, both Mangaceuticals and Nuclear Energy decided to call it quits. They mutually agreed to terminate that agreement. Why did they terminate it? Well, a key part of the deal was that they needed to get something called PIPE financing. PIPE stands for Private Investment in Public Equity. It is basically when private investors put money into a company that is already public, usually as part of a merger or acquisition. The agreement stated that they needed to raise at least $15 million through this PIPE financing, and that money had to be ready sitting in an escrow account by a certain deadline. Unfortunately, they couldn't get that $15 million raised by the deadline, which was the 21st of August 2026. Because this financing was a crucial condition to finalize the deal, both companies realized they couldn't move forward as planned. So they decided to terminate the agreement. When they terminated the agreement, it basically means it is no longer valid or has any effect, with a few exceptions. Certain parts like confidentiality and general legal provisions still stand. Importantly, nobody is let off the hook for any serious rule. Breaking that happened before they decided to end the deal. Each company will pay its own costs for this whole process. And they've basically agreed to drop any claims against each other related to this deal, unless there was intentional wrongdoing before the termination. This whole situation is detailed in a mutual termination letter, which is filed as an exhibit. It lays out exactly how and why they parted ways. Now, let's look at Mangaceuticals itself. They are a healthcare company, specifically in health information services. They have a market cap of about $9 million. Their stock price has been pretty volatile, trading between $0.16 and $2.75 over the last year, and currently sitting around $0.42. They're a very small company, with only 3 employees. It is also worth noting that Mangaceuticals is an emerging growth company. This means they have fewer regulatory requirements and can take advantage of certain relaxed rules, especially around financial reporting, for a period of time. The main takeaway here is that a significant planned business combination, which would have likely been a big step for a small company like Mangaceuticals, has been called off due to funding issues. This often happens with smaller companies trying to go public or merge, where securing the necessary capital is a major hurdle. The filing is signed by Jacob D. Cohen, who is the Chief Executive Officer of Mangaceuticals. He is the one officially putting his name to this report. So, what does this mean for Mangaceuticals? Well, it means they are back to square one in terms of finding a path to growth or a significant strategic move. The failure to secure the PIPE financing suggests that investors weren't convinced enough about the deal or the company's prospects to commit the required funds. This could be a significant setback, especially for a company with a small market cap and limited resources. It raises questions about their ability to raise capital in the future and their overall strategic direction. The risk here is that this failure to close a material deal might make it harder to attract future partners or investors. It could also signal underlying issues with their business model or financial health that made investors hesitant. For a small company, a failed merger attempt like this can have a prolonged negative impact on its reputation and ability to secure future funding. My biggest concern is the ability of such a small company with only 3 employees to generate the substantial growth needed to overcome this funding hurdle. The failure to secure the $15 million PIPE financing is a direct indicator that the market, or at least a segment of it, found the deal too risky or not sufficiently compelling. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If you found this analysis helpful, please like this video. Subscribe for more and join our community discussion in the Discord, all linked below.